Welcome back. So today I'll go into the fifth lecture of your second module, that is regulatory framework. I will take a look into the stock market participants, who are the individuals who actually participate in the stock market. The first one is stock exchange. So as the name suggests, without stock exchanges, you cannot have any participants involved. As far as India is concerned, major two exchanges which is computerized is the National Stock Exchange and Bombay Stock Exchange. So after 1991, we find that everything has become computerized in a computerized format, and these are the major stock exchanges from where most of the trading is taking place. These two exchanges are the major exchanges from where the major transactions in the stock exchange actually take place. So without this particular platform, it is very difficult for individuals to actually participate in purchasing or selling of shares. And of late, it is important to note that there is no physical presence required in order to purchase or sell a share. Everything is computerized, so it's become an easy platform from where we have actually started our journey. The next important participant in the stock exchange is the regulators. So the example of regulators, in the previous lecture I have talked about PFRDA. So PFRDA is a regulator who actually takes care of pension funds, right? So they may be borrowing certain rules and regulations from SEBI. They may be borrowing certain rules and regulations which is framed by MCA and other things. So they act as regulators for pension fund alone, but they are not directly involved in the regulatory activity of what SEBI does in other companies. Okay, so they are borrowing these from these major organizations, hence they are called regulators. Next is institutional investors. So for any economy to survive, you require investors to be part of the whole game. And here institutional investors, we mean to say that who are going to invest in bulk in certain institutions. So bulk investment is taking place. So institutional investors could be categorized into two. One is domestic and the other one is international. So there could be domestic institutional investors, there could be international institutional investors. So whenever you look at the criteria, you will find FDIs and FIIs coming into picture, right? So these are nothing but the institutional investors, that is the international institutional investors. Okay. Similarly, you also have certain domestic institutional investors, which is taken care by major financial institutions and banks who participate in purchasing stocks in bulk. So they become part of domestic institutional investors. Apart from that, banks to a certain extent, they provide advisory roles, and they also act as a depository participant. What do you mean by this depository participant? I am not going in detail. It's nothing but you can open a demat account. So demat account through which you are going to trade your shares. So whenever you purchase a share, it is depicted in the demat account in terms of number of shares being held, what is the current market price, at what price you have purchased, all these details are there. And whenever you sell that particular share, the shares will be deleted from your account, the money would be transferred to your demat account. And whenever you purchase certain shares, the amount what is available in the account will be transferred to the person from whom you are purchasing the shares. So that is a part of demat account, and this is how banks actually participate. They also take a role in wealth management activities, wherein if suppose that money is used in stock market activities, then we consider it to be a part of stock market participation by the banks. Then you have the non-resident Indians and overseas citizens of India. They play a very important role in the economy as such. Okay, and these are individuals who actually invest within the country. They work outside the country, but they are investing within the country, and through their investment, there is a growth in the economic aspect as such. So, these are persons who are not residing in the country for more than 6 months, and these are individuals who are settled outside. Let us say they have an H1B visa and other things. They are settled outside, but they are considered to be citizens of India. So, they are called the overseas citizens of India. Okay. So, they whatever savings they do, it is somewhere or the other put into the stock market, and that's how the stock market actually grows. That's another important aspect. You have domestic institutions playing a role in stock market. So, domestic institutions are those which are registered under MCA as far as India is concerned, and they actually participate in the stock market activities, either in terms of issuing of shares, in terms of purchasing of shares, or it could be in terms of selling of shares. So, any activity, or it could be in terms of advisory aspect. So, any of such activities which is being carried out by these institutions are considered to be domestic institutions as far as Indian economy is concerned. Next is investment banking. As the name suggests, the banks which are directly related with investment activities. Okay, and what does investment activities here mean? Here, since we are dealing with stock market, it says investment in securities which is traded in stock market. So, all those instruments which are traded in stock market, in which suppose you are going to make investment on behalf of your customers, then it becomes a part of investment banking, and they are part of the stock market participation. Okay. Stock brokers play a very important role, because directly as individual investors, I may not be in a position to purchase or sell a share, because these are the persons who would be helping me in saying how a particular stock is behaving, what shares has to be purchased, what is the right time to purchase a particular stock. All these things are there, and they are registered brokers in the stock exchanges. So, through them we would be purchasing the shares in the Indian stock exchange market. So, they play a very important role, without which individuals like you and me may not be able to participate in the stock market. You and me, as I told, would be part of investors category, where the savings of myself is put for future benefit. So, I believe that if suppose I am saving 100 rupees today, instead of keeping it in my bank account, which is going to give me say 4% rate of interest, I would be interested in putting this money into the shares of a company which can give me a return of say 10% or 12%. So, investors normally put the money for future returns with the expectation that you would be getting a future return. So, they are also participant in the process. Next is depository. So, depository is those bodies who actually maintain the accounts of shares on behalf of company. As far as India is concerned, you have CDSL and you have NSDL. CDSL takes care of the accounts of shareholders of all the companies which are listed in BSE, and NSDL takes care of maintenance of shareholders' accounts which are listed in National Stock Exchange. Okay, and how do they function? They are linked to the financial institutions, and these financial institutions are called depository participants, and they are like banks. It could be ICICI, it could be SBI, whichever banks open demat account. So all those are depository participants. And in private sector, you have Religare, you have Indiabulls, all these are part of it. So they are called depository participants. So these are depository participants who have direct relation with public, and this money from the public is invested here. This money is transferred to either CDSL or NSDL whenever the shares are purchased or sold. So there is an interrelationship between these also. If suppose there are shares which are traded in both NSE and BSE as well, then they would be sharing the information among them also. Next is credit rating agency. So credit rating agency like CRISIL, JP Morgan, or you can call it as Morgan Stanley, anything of that sort. So what they do is they try to take a detailed study of the financials of the companies, and they would be rating them either as A plus or triple A or anything of that sort. Okay, so whenever these companies want any debt or anything, the banks would be taking care of these rankings, and accordingly they would be providing the interest rate, fixing the interest rate. They would be deciding on how much loan has to be given, right? Similarly, if it is for loan, it is this part, and if it is for insurance and other things, these information would be available to the investors, and they can take a decision as to which policy has to be purchased, because the risk factor is either mentioned in these criteria. So the credit rating agencies are those agencies which actually rates how the company is functioning or how a particular fund is functioning. It need not be for the total company, it could be for one fund separately as well. So based on that, you can take a decision how much risk you can take and whether you can put in your money or not. So same thing is followed within the stock market, because stock market has participation of debt instruments as well. Okay. Now next is transfer agents. Again, transfer agents are those individuals or persons who actually on behalf of the customer, they would be dealing with the stock exchanges. Something like a broker can also be considered as a transfer agent. So if suppose there's a big broking house and have many sub agents over there, then each sub agent would be considered as a transfer agent who would be having direct relation with the public. So this is the participation of transfer agents over here. Next is mutual funds. Mutual funds are, as I told you in the previous lecture, these are funds, small funds collected from different individuals. Collectively, they are investing into a big stock. Okay, so this could be one share, or it could be in shares, or it could be a combination of shares plus debt instrument, right? And they are again traded in stock exchange, right? So the mutual funds can also be traded in stock exchange, where the stock exchange would be providing the net asset value at which it is traded, and you can also purchase and sell mutual funds within the stock market also. The linkage between the mutual funds and the asset management company is that the company which manages this is called your asset management company. Funds collected from, small funds collected from individuals put together will become a fund, and this fund is being managed by an asset management company. Okay. So, it can be for one fund, it can be for multiple funds, it depends on various things. You have Tata Asset Management Company, you have n number of companies. Okay. So, that is how they actually take a decision as to which is the shares in which it has to be invested, depending on the criteria how the fund has been collected. If suppose these funds have been collected from aged persons, which means to say that they are not ready to take high risk. So, what the asset management company would be doing is they would be identifying debt instruments which can give maximum return for these persons. If it is young individuals, they are ready to take high risk, then in that case they invest in shares, and within the shares they will be deciding as to whether it should be blue chip companies, whether it should be Nifty 50 companies, whether it should be BSE 100 companies or 200 companies. So, like that they take a decision how the total money has to be distributed within among the different securities which is available. Next is domestic retail participants. So, these are individuals like you and me who can directly participate in the process of stock market, where I can purchase and sell if suppose I have a demat account with any of the depository participants. So, these are, I am considered to be a retail participant, and since I am from within the country, I am called a domestic retail participant, where I take a decision on my own by doing the analysis of shares or debts or whatever instrument I am interested to invest, and I directly either buy or sell based upon my wisdom. So, they are called domestic retail participants. Next is regulatory body. So, example is SEBI. So, these are big body which has a control over other regulators. As I told you in the previous slide, PFRDA is a regulator, whereas SEBI is a regulatory body. So, that is how you will have to segregate, whereas regulators can borrow rules and regulations from regulatory bodies. Without doubt, companies will have to be participant in the stock market if suppose it is registered as a public limited company. Why public limited company is part of stock exchange? Because whenever the company size increases and they require fund money more than what an individual or a group of investor can put in, okay, then they sell the business idea to public. Let us assume capital investment required in my company is 2 crore. Which I believe that no individual can give me, or a group of individual whom I know cannot give. So, in that case what I do is I divide this 2 crore into small parts, and each part is known as a share. So, share, and the public is authorized to purchase the share. So, this share would be in divisibles which is affordable by the public. So, I say the share is 10 rupees or the share has a value of 1 rupee. It depends upon the requirement and wisdom of the company. So, I can have 2 crore shares of 1 rupee each. Okay. So, this is affordable by public at large. Whoever wants to purchase it can purchase it, because 1 rupee is a very small amount, and it goes, I am selling the idea to the public. So, whoever is interested in my idea can invest in my company. So, in this way public limited companies become a part of stock market. Next is clearing corporations. Here what happens is we were talking about the commodity markets. Okay. So, in commodity markets what happens is I may have to take delivery of goods. if I have to take delivery, let us assume that I'm I've invested in bullion or gold, okay, and I have told that I'm ready to purchase 10 ounce of gold on say 31st of October. So, if suppose I want to take delivery of this 10 ounce of gold on 31st of October, there should be a place from where I can collect, and this is nothing but the clearing corporation. So, this is the place from where I can take physical delivery of these goods in case of commodities, okay. And otherwise, when I am talking about virtual items, then clearing corporations are those organizations which takes care of the transactions which has been done, which is normally as on date, which is normally done by the depositories and depository participants, okay. So, that is the role of clearing corporations. Then you have intermediaries. So, intermediaries are persons who are directly not visible in the stock market, but without whom the process of dealing with stock does not get completed. For example, the most common used thing would be brokers. So, brokers are those intermediaries whom we are visibly interacting and with whom we can transact and get stocks and other things purchased. Apart from this, if it is initial public offer, then you have the underwriters, you have the issuing bank, you have the clearing houses, all become part of the intermediaries. Investment advisors, it could be banks, it could be insurance companies or agents. So, any part of it can act as insurance advisors, or as on date you have something called a wealth manager who actually takes care of where your money has to be invested by his research activities and other things. So, this is being done by investment advisors. Then you have portfolio managers. So, portfolio managers, for example, I've built a fund for infrastructure development, okay. So, mutual fund which is dealing with infrastructure development. So, I collect money from different persons and I say that if it is for infrastructure development purpose, there will be a lock-in period of say 3 years, and all the money whatever is collected would be routed for infrastructure development. So, this is a portfolio. So, infrastructure development, again I can divide what are the infrastructure development. I am investing in road construction in Himachal Pradesh. I am investing in sewage plant for industries in UP. So, like that I can select the different funds in which I would be investing, and totally this becomes a portfolio, okay. I can manage a portfolio of this sort, okay. So, that is called a portfolio manager. Custodian, whoever is owning a particular share or a debt instrument is called a portfolio, is called the custodian of that particular stock. Issuer is nothing but it could be the company directly, or it could be the agents on whose behalf the company is issuing it. Security exchange, again it is a combination of shares, debt instruments, commodities, all these things, all different securities whichever is available, all these things put together, you can put it in securities exchange. So, I've just given a background of who are the actual participants in the stock exchanges and what their role could be. There are many more participants in the stock exchange if you are going to look at from the long-term perspective, from the economy perspective, but these are some of the common participants in the stock exchanges, and I hope that you get some value addition by going through this particular lecture. Thank you.